$50,000 in your international investments just became vulnerable, and you probably have no idea the ECB already triggered it. This is a wake-up call for high-income professionals managing international assets. You believe ECB rate hikes won't significantly impact your international portfolio. That belief could cost you $50,000 to $100,000 over the next 5 years. Here's why. According to the European Central Bank's 2022 Financial Stability Review, a single 1% change in the euro to dollar exchange rate creates a 5-10% swing in international investment value. For $1 million portfolio, that's real money vanishing or appearing based purely on currency movement. Most high-income professionals managing international assets have never calculated this exposure. Let's walk through the mechanics. When the ECB raises rates, the euro appreciates relative to the dollar. That sounds positive until you own US equities or dollar-denominated bonds. Your gains compress. Conversely, if you own European assets and hold them in dollars, currency headwinds flatten your returns. A portfolio earning 6% in euro terms might only show 3% to 4% in dollar terms after exchange conversion. Over 5 years on a $1 million base, that's the $50,000 to $100,000 delta we're talking about. To put this into perspective, a 5% loss due to currency fluctuations could mean a reduction of $50,000 in your portfolio, while a 10% loss could mean a staggering $100,000 less. Now let's look at a specific example. Suppose you have a $1 million portfolio with 60% invested in European stocks and 40% in US stocks. If the euro strengthens by 5% against the dollar, your European holdings could increase in value by $30,000, but your US holdings could decrease by $20,000 due to the stronger euro. That's a net gain of $10,000, but it could have been more if you had hedged your currency exposure. Here's the hidden detail most advisors skip. The ECB's recent rate hiking cycle, moving from negative rates in 2021 to 25% by mid-2024, has already shifted currency dynamics significantly. The euro strengthened roughly 8% against the dollar in 2023 alone. If you held a diversified international portfolio that year, some of your gains evaporated in the currency translation. The research indicates that currency fluctuations now account for 40-60% of international equity returns volatility for dollar-based investors, according to studies in the Journal of Portfolio Management. But let's not forget the impact of compounding. If you have a $1 million portfolio and you lose 5% due to currency fluctuations, that's $50,000. But if you lose 5% every year for 5 years, that's a total loss of $281,000. This is why it's essential to understand the impact of currency fluctuations on your portfolio. Why does this matter right now? The ECB is signaling further rate decisions through 2025. Each announcement creates microshocks in currency markets. High-income professionals with $1 million or more in international exposure face compounding currency risk that most quarterly statements don't isolate. Your brokerage statement won't tell you how much of a loss was currency-driven versus fundamental underperformance. That blindness is expensive. For instance, if you have a $1 million portfolio and you lose 10% due to currency fluctuations, that's $100,000. But if you don't understand the cause of the loss, you might make the wrong decisions about your investments. The numbers are specific. Consider a scenario. You hold euros 300,000 in European blue-chip equities and $700,000 in US dividend stocks. At today's rates, roughly 10 euros per dollar, your total portfolio is $1 million USD equivalent. If the euro weakens 5% over 18 months, a realistic move given ECB policy divergence with the Federal Reserve, your European holdings lose roughly $13,500 in value just from currency movement, regardless of stock performance. That's a 35% portfolio haircut from exchange rates alone. To mitigate this risk, you could consider hedging your currency exposure. For example, you could buy a currency forward contract to lock in the current exchange rate, or you could invest in a currency-hedged ETF. The proof is in the data. The Federal Reserve's monetary policy reports consistently document the inverse relationship between U.S. rate hikes, which strengthen the dollar, and international asset returns for American investors. When the ECB tightens while the Fed holds, the dollar weakens temporarily. But when both tighten at different speeds, currency misalignment creates exactly this squeeze. For instance, if the ECB raises interest rates by 1% and the Fed doesn't, the euro could strengthen by 2-3% against the dollar. This could result in a 2-3% loss in your US holdings due to the stronger euro. So what do? First, audit your international holdings by currency exposure. Separate European equities from US equities from emerging market holdings. Know your euro exposure as a dollar investor. Second, consider hedging instruments, currency forward contracts, put options on the euro, or simply reducing concentration in any single currency block. The takeaway: audit your international portfolio today, calculate your euro exposure, and decide whether currency hedging makes sense for your situation. Markets reward the patient and the prepared. By taking the time to understand the impact of currency fluctuations on your portfolio, you can make informed decisions and avoid costly mistakes. Remember, a 5-10% swing in your international holdings can mean a difference of $50, 000 to $100, 000 in your portfolio. Don't leave your retirement savings to chance. Take control of your investments and start hedging your currency exposure today.